Hello ladies and gentlemen, and welcome back to Investing for the Common Man. Today I want to take a quick break from my usual short and sweet educational videos to just encourage you all and share some sweet gains from my personal portfolio. You probably clicked on this video because you saw 300% gains in 5 months and are wondering which overbought tech stock or high-flying penny stock I'm talking about. And the answer is neither. This wasn't some volatile investment in Tesla with its crazy whipsaw of a chart. It wasn't some IPO that had never turned a profit or a lucky bet on some obscure penny stock. And it certainly wasn't one of those 3x leveraged ETFs like JNUG or JNUS that's been getting all sorts of hype and fan service on online message boards. This 300% gain is just from investing in simple stock, not high-risk leveraged option plays like most of the gains you see on Wall Street bets. I picked this stock because I saw an opportunity and believed in this well-established company's product and innovation to pull through a rough economic patch. If you've been following my channel for long, this underrated stock has made it onto my top 5 monthly stock picks 3 times as a value investment, innovation investment, and dividend investment. You're probably sitting there asking yourself right now, what the heck kind of company is he talking about? The stock I'm talking about is restaurant franchise holding company Brinker International, ticker symbol EAT. Brinker International owns the Chili's and Maggiano's Little Italy restaurant chains, with a total of 1,650 locations nationwide. Both of these restaurants already had strong takeout followings and infrastructure in place before the pandemic. In addition, just over a month ago, Brinker International launched an entirely new, low-cost, takeout-only restaurant chain with over 1,000 distribution centers practically overnight. The new chain is called Just Wings, and the food is prepared and sent out from kitchens of pre-existing Chili's and Maggiano's restaurants in a delivery partnership with DoorDash. This entirely new restaurant brand will have practically zero additional overhead expenses and create a brand new niche and revenue stream for Brinker International. Just the other day, the CEO said that they expect this new digital brand to gross over $150 million in its first year. This is exactly the type of creative thinking and innovation that you want to see from companies in your portfolio. I scaled into this stock back in late March with an average cost basis of $11.25 per share. If we look at the chart, you'll notice that I didn't manage to pick the bottom of $7 per share, but that's okay. Expecting yourself to successfully be able to pick the bottom is an unrealistic expectation. I waited to commit to this position until the US government started approving various stimulus measures, and I was confident that this business was not going to go bankrupt. I then resisted my temptation to try and trade in and out of this stock. If we fast forward to today, the stock alone is up over 300%. Mainly due to analysts like JP Morgan, who had viciously downgraded the stock during the height of the pandemic, finally changing their tunes and updating their price targets to reflect the success and innovation of this company through one of the toughest economic periods for restaurants in modern history. I wanted to share this real-world example from my own portfolio to encourage you to do your own research and trust your instincts. If you look at the reports of major stock analysts and think that they're missing part of the bigger picture, that can be the best time to trust your instincts and scale into a stock. Because you want to be holding onto the stock when the analysts finally realize their mistakes and upgrade the stock, not piling in with the rest of the market after 10 analyst upgrades and the stock is quadrupled in value. So I guess you might be wondering, is EAT still a buy? Am I going to sell the stock now that it's made it back into its pre-COVID trading range, or do I hold on to it? Well, my original plan was to sell as soon as it made it back into its original trading range between $45 and $55 per share. But with the innovation and new brand of this company, I bet this stock has a bit more juice left in it. Before the pandemic, EAT paid a consistent and increasing healthy dividend for 8 years straight. But in the second quarter of this year, Brinker had to suspend its dividend, which hurt the stock. But with the company's strong comeback and innovation, I'm willing to speculate that they will be eager to reinstate that dividend in Q3 or Q4 of this year, which I'm sure will give the stock price another boost. So to answer your question, I do not plan on selling my position. I may take some profits and let the rest run, and I'll likely continue to sell covered calls to continue to rake in some option premium to augment my gains. But I think EAT's success story is not quite over yet. Thank you guys for watching, and I hope that this video has encouraged you to get out there, do some research, and trust your instincts while still sticking to your trading plan and avoiding unnecessary risk. If a 300% gain in 5 months isn't enough to get you to smash that like button, I don't know what is. For more stock market analysis and educational resources, please hit the subscribe button. I've got my very first collaboration with another YouTuber coming out on Monday, so you certainly won't want to miss that. Until next time, keep calm, stay healthy, and happy trading.